Our session topic this morning is Global Pension Funds Under the Spotlight. And so we're going to think about what we can learn from the UK and to some extent European example and from the US example, and what is best practice in those two areas. And we have with us John Panagakis, who's the Head of Asset Management Business Development at TIAA CREF Asset Management. Welcome, John.
Thank you.
Clap, clap, clap. And Joanne Seagas, the Chief Executive of the National Association of Pension Funds in the UK. Welcome to Joanne. So, John, we were saying we shouldn't just assume that everybody knows what TIAA CREF is. So why don't you and then Joanne give us a bit of a sit-rep of your organisations and what's the latest going on in your area?
In brief, TI CREF was founded by Andrew Carnegie as he was giving money away to universities. It is an industry fund that focuses on universities, independent schools, teaching hospitals, and other non-for-profits. It was founded as a defined contribution pension scheme. We have about 5 million members and about $600 billion US under management.
And the NAPF is the peak body for workplace pensions in the UK. We have 1,300 members from the for-profit and not-for-profit sector, defined benefit and defined contribution. Our members collectively provide pensions for 17 million people and have £1 trillion, it's about 2 billion Australian dollars worth of assets under management. And our job, much like AAST's, is to lobby the government in the UK and in Brussels for a better pensions deal for everybody. And
just before we go on, Joanne, you've had the budget while you were here. So I imagine you've been working Australian hours and UK hours
just a bit
all at once. Now, in the course of that budget, there were a couple of key decisions that were made. Take us through those and what are the implications of them?
Well, the changes that came about in the budget were really an extension of the Chancellor's announcement in the last budget, last March, when he basically said, rather than continue the requirement in the UK that for the majority of people they have to buy an annuity when they want to draw their income, when they want to draw their pension from their DC pot, they could do what they like with it. So they could take cash, they could buy an annuity, or they could draw down. Or in the words of our pensions minister, they could buy a Lamborghini. Slightly ambitious, given that the average pension pot in the UK is about £24,000, so about 40 or 50,000 Australian dollars. So I think you might get a wing mirror of a Lamborghini for that. But so they were the changes that were announced last year. Those changes come into effect on the 6th of April, so we don't quite know how they're going to work yet. We've just about got all the regulations.
And you're just having a big debate about advice. And if you're going to offer choice, then you must offer advice.
Guidance is the key word, not advice, and that's going to be quite a critical distinction as we go through this. But the change that was then announced in the budget, and I got a heads up from this when I arrived at Sydney Airport, kind of exceedingly jet-lagged, on Sunday, and I opened up my phone and there was a text from the Treasury saying, get in contact, the Chancellor's about to make an announcement and we want to give you the heads up, which was at least a step in the right direction. And that was really the idea that for those people who've already bought an annuity, they'll be able to sell back their annuity. So, and we were just talking about this, effectively an annuity is really a lifetime product. So the big question now is, how can we ensure that people can, if they want to, sell back their annuity and do that in a way that frankly doesn't involve them being ripped off. And for that we'll have a consultation paper. Those changes, if they come about, will come about in 2016. We've got a general election on May the 7th this year, so who knows if they will actually come to pass. So it's really an extension of what the government are calling freedom and choice. You've saved your money. Once you've saved your money, it's your money. Who are we, the government, to tell you what to do with it? So that's a sort of continuing dialogue that's going on, but of course it brings huge challenges. And so I've been very interested while I've been here to listen to how you've dealt with that, given the financial systems inquiries pulling you in the opposite direction.
Very much. And then the other change that I noticed was that the Chancellor announced that he'll cut the unsustainable lifetime allowance, the maximum amount that can be saved into a pension, from £1.25 million to £1 million. I mean, you can still put in more, but essentially you'll be sacrificing most of it to them.
So quite clearly no one's going to do this. And this again is a sort of continuing trend that we've seen, partly in response to the global financial crisis. Prior to 2010, you could put about £3.5 million into your pension pot. So that's come down quite substantially to £1.5 million, £1.25 million currently.
And is this in answer to the question, if you're devising a retirement system, at what point are you going to cease using taxpayer breaks to provide for somebody's retirement and become sort of a wealth creation vehicle for the very wealthy?
So some of it gets wrapped up in questions about redistribution. And in addition to a lifetime cap, we also have an annual allowance, so you can only put in up to £40,000 each year tax-free. So some of that's about redistribution and using the pensions tax system to redistribute. If you get tax relief at your marginal rate, clearly more of that goes to higher earners. But quite a lot of it's about revenue to the Treasury. So this change will bring in about 600 million a year.
Yeah.
And the government made no bones about the fact that everyone's got to pay through the GFC, and pensions tax relief has been one way of doing that. And it's a kind of invisible tax. You can dress it up as a fat cat tax. That's been part of the rationale for that.
And John, coming back to the the US, give us more of a sit rep on what are the big challenges for you in terms of the system.
Sure. I think everybody knows there's a major movement from defined benefit plans, defined contribution plans in the US. We don't take sides on that debate. We talk about outcomes, and sometimes a defined benefit plan where you've been with an employer for 30, 40 years is the best option. Sometimes if you're moving from employer to employer, defined contribution plans could provide an adequate level of income. It's really about the contribution rates, the fees, and the asset allocation that member. So it's about education, because in the DB scheme it was set it and forget it, and now it's member engagement, advice, guidance, working with them to make sure they're maximizing their contributions and understanding what they're doing before they hit 50. Because that's when they finally open up those statements and look at it and say, I better think about retirement.
And you think it's too late at 50?
It generally is, yeah.
Yeah. I should have said at the beginning, if you would like to ask a question, you can go to your app and use the Ask a Question function in the app. And there are some people like me who are very resistant to doing any of that nonsense and want to put their hand up and have a microphone brought to them, and we can do that for you. You might need to say "Oi" loudly, but I can make that happen for you. So go ahead and ask questions there. John, we were talking before and to Tom Garcia, and he was saying one of the key things he wanted to hear from you today was, given the size that TIA-CREF is now, when you look back at that growth path, what are the lessons you take? The things that you did too slowly, the things you did too quickly, the things you would have done differently?
Yeah, so I've been with the firm for 27 years and started off managing the call centers and various management positions throughout the organization. I think similar to the challenges that I see in Australia, it's about technology and being cutting edge. It's looking at the competition. In the States, it's from the banks or from the brokerage houses that are seeing all this money accumulate, and they want to take it out of our schemes, and that's why we've built certain areas. So it's technology, it's building or putting more people in the field at the universities to give that counseling and guidance throughout their careers.
Because of the competitive environment.
It is, because we'll lose, if we're not engaged with those members, they'll just take that money and move it over into an IRA with one of the brokerage firms or the banks. And scale helps all of us. It's not about being big for the sake of being big, but the efficiencies and the cost savings we can provide to our members by doing that. And if I could do something at 25 basis points and educate them about that, for the broker that's going to charge them 150 basis points, that's about the outcomes that I was talking about.
But see, the emphasis in Australia is about low cost advice, and that's been forever, but particularly out of the GFC. And Joanne's just said guidance, only guidance, you know. There's a cloud, see if you can find some guidance in it about which bit of the Lamborghini you can afford. How do you do that? Is it just economies of scale, given that you're so massive?
It is, and there's two different groups that we have. So we have a field consulting group of about 200 people. They're agnostic. There's no fee. It's going in and providing that advice during your working years, and that's free, but that's scale for us. Now, for those who accumulate a lot of money with us or consolidate savings with us, we do have a wealth management group, and there's 700 people in that group. And that was direct response to losing money because we are a mature organization. Social Security pays out the most in terms of retirement benefits. We pay out the second most.
Really?
So you just don't want to see those dollars go out the door. We want to go to and through retirement and have a lifetime relationship with
And
our
can you
members.
do that if you're not huge?
I think that's where we can all learn from each other and say, what's the best way to do this for our members? And you could start off small and then see how that goes over time. And then for the wealth management services, we do charge a service for those fees. For the basic, you don't. So I think it's testing the waters, but there is an economy of scale that plays in well.
And it's quite an interesting challenge to think about that and then apply that to the UK pension setting, where we've got 6,000 separate DB schemes, 40,000 separate trust-based schemes, so a lot of very, very small schemes, and a price cap of 75 basis points, where everything we do has to be provided by those quite small schemes at a relatively low fee, and typically fees are much lower than 75 basis points anyway. But to do that in a very small setting is quite a challenge when governments are putting more requirements on schemes to provide guidance through the new guidance service the government's setting up.
So then do you start having the
themselves.
debate we have here about only the strongest survive, you end up with an amalgamation of funds and so forth?
And so we might see not mandated, but a sort of push towards scale, and we're starting to see some master trusts or super funds being set up in the UK. But it's quite a challenge to think about how do you do that? How do you serve your members so well when actually your ability to leverage those economies of scale is really quite small?
It is.
How do you answer that?
Well, I think part of it is cooperation or competition, cooperation together. You put those together because
good word.
Everybody is looking to retain their member, but also looking to gain members from the other funds out there. One way may be getting together through an organization like AIST and say, how do we collaborate where there's certain rules and guidance and you build an infrastructure and a framework, at least to get it started.
There's a question on the screen there. John, when does scale not work for you?
Scale doesn't work when you're talking from an investment perspective, and we work with universities and endowments, and we manage money for some of them. Some people want the boutique, niche little firm where there's no big organization associated with it, so that
Is that just a temperamental decision, or is there some
I think
wisdom behind that?
There is some sage advice from people like David Swenson at Yale, who sits on our investment committee as well. But it's when you want to be nimble and quick and go in from an investment perspective and say, let's do this today. You have risk management, you have others. That was more of a problem before the GFC.
Yeah.
After the GFC, people appreciate having strong risk management, strong compliance, strong guidance in place, and not doing things based on financial engineering or gearing.
Just before we go on to the next question, who's on your investment committee?
It's been people, and we saw some of the names, people like Paul Volcker,
Really?
Schiller, Swenson, over the years, not right now,
Sure.
but through. So the investment committee and the board, and I think this is an interesting fact, we used to be almost all academia on our board, and we've mixed it where it's about half academia and half from business to get that perspective from the competition, from the for-profit organizations that are coming in and looking to take market share away from us. So our market's a little bit different, but you have the big mutual funds and the big insurance companies wanting to beat us out. So that's the competition we're facing whilst in the plan, as a matter of fact.
And the distinction being as well on the investment front that you make investment decisions in-house.
We do.
There's another question on the screen there. We'll just quickly tick past that, Joanne. In the UK, will it be obligatory for funds to allow cashing in of annuities, or can they decide not to offer the option? Will they assess the member's health before offering cash-in terms? This goes to the heart of the choice question, doesn't it? You know, we were having the debate yesterday in the digital session. Do you allow people to make bad choices?
Well, the answer will be yes, in the UK context. So in the UK, when people buy their annuity, they buy that from an insurance company. So there's somebody waving over there with a question.
Oh,
very
okay,
excited.
good for you.
I like the fluorescent. So people would tend to buy their annuity or transfer out of the pension fund, so their employer-sponsored pension fund, and buy the annuity from an insurance company, pension funds don't self-annuitise because that's too complicated. So insurance companies, if somebody comes along and says, I want to cash in my annuity, will presumably have to do that. We'll have to see exactly the terms of the consultation and the response to the consultation. But of course, in the intervening period between when you bought your annuity and when you want to cash in your annuity, you've got older, your health may have deteriorated, your circumstances may have deteriorated, and these are all factors that will have to be taken into account. So how you
unscramble that egg is not clear at all, is it?
No, not at all. and how you then explain that to people who may have quite a different expectation of what their fund might be. If they started off with £100,000 and they've taken it for a couple of years, they might be expecting the lion's share of that to come back. Well, first of all, they're going to have to pay tax on it, or whatever their marginal rate is. There'll presumably be a cost to the insurer because they've had to manufacture the annuity in the first place. And their personal circumstances will have changed, including their health, as the question said. So all of these factors will have to be worked through. And the government has said, and the Chancellor said on Wednesday, that his assumption is most people will not want to do that.
Right.
But again, with big sums of money potentially flashing before people's eyes, maybe people will. So a big part of the consultation is going to be how do we stop people making daft decisions or decisions that are not in their long-term interests.
We'll go to the question on the floor.
Hi, Bruce Hartnett at Vic Super. Just wanted to ask Joanne, in the UK, how do you protect against dodgy financial advice? I mean, 20, 30 years ago in the UK, there was a financial planning scandal, where the way financial planners were remunerated encouraged dodgy behaviour.
Not that we ever have that here.
No, exactly. So how in the UK will you protect against that, particularly in the context of your answer to the previous question?
Yes. Yeah, and it's a really good question because I said that when we have this annuity freedom and choice day coming in a couple of weeks' time, people will get guidance. They can go to a new service the government set up called Pension Wise. They can access this on over the internet. There is a website if you want to have a look at that. They can do face-to-face. There are 50 sites around the country where people can go get face-to-face guidance, so it's not exactly going to be on your doorstep, or they can do it over the telephone. Small point of detail, we don't have the telephone number yet, even though it's on the 6th of April. And the government's assumption is, I'm sharing my pain with you, you can tell, but and the government's assumption is that people will then, once they've had the guidance, go and get advice. And you raise a very important point, which is A, advice is quite expensive, and B, it's not necessarily very trusted. So part of the way in which we've dealt with the High Commission's point and those sort of hidden trail commissions points, which is partly the heart of your question and some of the distrust that sits around financial advisors, is by having something called the Retail Distribution Review. So basically it's a sort of fee for advice service. So that's at least much more transparent. But there's still a question of trust and affordability. If you've got £24,000 in your pension pot and the cost of advice is £1,000, that's quite a chunk of cash you're going to have to part with.
All right, there are questions on the board there about member engagement. I'll come to those in just a minute, but I want to talk about the evolution of board structures over the next few years and any challenges on the horizon there. We'll start with you, John. How do you see boards evolving?
For us in the States, it's really the fiduciary standards that have come into place that have put weight on the shoulders of trustees and board members. They will hire independent auditors to come in and take a look at us and what we're doing, as is their right. There are a multitude of lawsuits in the United States around 401k plans in particular. So there's that burden on trustees and board members that probably wasn't there 10 years ago. That's why somewhat of the movement of having people from the industry as well as having, I won't use the term professional trustees, but somebody who understands the regulatory and the legal environment from that and can help the rest of the trustees in that environment.
And do you lose anything with professional trustees?
I think as long as you don't go too far over, because at the heart of it, it's what you're doing for your members. That is all of our charge, I think. It's the degrees of influence, and I think it's that balanced approach that probably works best.
And we've seen a similar trend in the UK, particularly amongst defined benefit pension schemes, to have more independent trustees on trust boards, especially as we have really quite tough negotiations about scheme deficits. Almost all defined benefit pension schemes in the UK are in deficit. So as we have really tough negotiations between the trustees and the sponsoring employer on deficits or scheme buyouts and wind-ups, that has brought in a new breed of independent trustees, generally professional paid trustees, very often in the position of chair. And we've also seen a decline in the number of plan sponsor representatives on trustee boards. So very, very few finance directors, very, very few CEOs will now actually be on the board of their own, their own trustee board. And that's partly regulatory, it's partly the regulator saying you've got to have a much sharper division between the trust and the sponsor. But overall, what we've seen in the UK is an improvement in standards of governance, and that's been particularly so on the DC side. As I say, very small scheme, so quite a lot of scope for poor governance, but we have seen, and again partly driven by a regulator, partly also driven by the work we've done at the NAPF, to really drive up standards of DC governance. And I should also add, of course, we're not just regulated by our own government. In the UK, we have European legislation to contend with too. And there's a piece of legislation just working its way through the European Parliament at the moment, which again focuses very much on defined contribution governance and setting more professional standards for trustees. And at one point that was much more pushing towards qualifications and professional trustees. We've pushed back on that because it does go against that principle of lay trustees that we have embedded in the UK system.
There's a question on the screen here. John, could you comment on the fund's competitive position and how you dealt with the opening up of your default status? And the questioner goes on to say, as I understand it, TIAA-CREF owned the segment before the government opened it up to competition.
Right. So when I first started with the company 27 years ago, we had 99% of the market. We were the trusted, we were their company. We're owned by our members. And going back to paternalism, at that point in time, the universities only allowed for annuitization. And now it's one of the options on the menu. So what I've talked about is the evolution of the company, where we have others coming in. They went to a multi-vendor approach at a Columbia University or at Stanford, where they'd have TI-CREF and then 3 or 4 other providers on the campus. And going after the same plan member, we tended to continue to have the bulk of the market share, but we didn't have the advertising. I won't use their names, but you could imagine who some of those are. Yeah. They're big for-profit companies with huge advertising budgets that a 24-year-old coming in as a new uni professor knows that brand but doesn't know ours. So we've had to reshape, redefine, rebrand. Technology was a major challenge for us.
And how did you do that? Because that's a key question here, you know, with the banks eyeing superannuation and all the rest of it. I mean, their brand recognition is huge. How do you do that? Can you fight in their space, or do you have to do something different?
I think you need to be strategic to a certain extent. You can't do advertisement on the finals of the footy game because that's too expensive, right? So you have to target your audience in the periodicals they read and the programs they write. For us, it's on the campus or at the work site. I find the best advertisement or the best person is to get the older shop steward who brings the new employees in and is their mentor and work with them cooperatively.
Finding opinion leaders and so forth.
Exactly. That really works the best for deans or for the groundskeepers or for the hospital workers.
Which is easier to do in a structured learning environment like a university, right?
It is.
Because you know who's who.
But it's a major challenge, and we've increased our marketing budgets. So it is that balance of keeping costs as low as possible, because that is in our mission and our charge, at the same time looking to see what we can do to retain and grow with our members.
What is the likely future of CDC products in the UK when there are so many small pension funds? Are these products featuring in the US? Just quickly on that one, if we can. So
CDC, collective defined contribution, it's something which is a great passion of our current pensions minister, he of the Lamborghini quote. there's not a lot of appetite, it has to be said, for CDC amongst my members, my pension fund members, and we do talk to them, and the minister keeps saying, but somebody's going to come out of the woodwork, and I promise you someone's going to come out and raise their head above the parapet soon, and kind of nobody has. And I think it's partly because schemes are just looking at a whole bunch of other stuff, including the freedom and choice reforms, including governance, so I don't see any great groundswell for it.
In the States, there's been government-led efforts to try to say, by the current administration, we're going to create a simplified system, just like we have at healthcare now. And then at some state levels, there's been, we'll create a state-level system. They really haven't taken off. The preponderance of the employer-sponsored plan is dominating the market.
And why do you think that is? Is that just a cultural thing that you guys don't do central planning that well? It's just
it's
not in your DNA?
It's the cowboy mentality. You know, you watch the old Westerns, and the Americans really think, you know, I have to be independent, and I don't want Big Brother in my soup, to a certain extent. So I think there is that resistance, and there's certain media pundits and politicians that anything that's centralized, they're going to come out strongly against.
We should talk about your insights, John, into fund investment trends. What can you share on that front?
Yeah, for us, Tom and I were talking earlier, we started investing money internally almost from the beginning, and that was pretty simple because all we had at first was TIAA, and it was government and corporate security, so you could build out a small team. Then CREF was founded in 1952, equity. We brought our own equity team in-house. So I think that's where, even if I look at the CalPERS or the CalSTRS or the big Canadians, they started with the equity and the fixed in-house. What's been evolving for us is in property, we built organically. In places like agriculture and timber and private credit, we're bringing teams in-house as a large investor because we found the fund scheme was too expensive and then separate accounts. So we've been building almost all of our investments in-house. We have 375 investment professionals on staff. The only thing we really do outside is traditional private equity leveraged buyout funds, but we've been bringing everything in-house.
And do you see that as is that peculiar to your fund, or is that a trend that you're going to...
I think you're seeing it's a trend. So whether I look at the Norges banks of the world, the sovereign wealth funds, or the OMERs with 120 people on their infrastructure team, some of the European schemes, the Scandinavian schemes, it's more and more of a trend. And what we're finding as we talk to those big organizations is how do we cooperate on investing together in some of those key areas.
Joanne, on that point of the trend to in-house fund investment, what do you say?
Well, we do see some of our larger defined benefit pension schemes setting up their own in-house investment teams, not huge numbers, but they are setting up their own in-house investment teams. I think of some of our larger supermarkets, Tesco, for example. Our rail pension scheme is bringing much more of their investment in-house, and the University Superannuation Scheme, the equivalent to TIACREF, is also developing very big in-house investment capabilities. And I think this goes to a bit of a wider debate that we're having in the UK about making sure that we get value from our investments, get value from our investment managers and investment consultants. We've got quite an intermediated investment chain in the UK. But that we can really get value out of that value chain and make sure, and I was struck by some of the debates in the sessions yesterday, that we've got our investment aligned with our own interests.
And what do you mean by that exactly?
Well, so that take infrastructure, for example, that we're not charged 2.20 for a buy and hold investment, so that we can actually make sure that fee structures are appropriately metric, so we're not overpaying, but also that their structure is actually aligned to our interests, particularly for closed defined benefit pension schemes, where we're trying to sort of match our liabilities, and what we're after are sort of long-term, low-risk, inflation-linked returns, that we can make sure that the fee structures are appropriate to that. And one of the ways we've tried to do that in the UK is to say, well, actually in the space of infrastructure, we don't like what we see, so we've built our own version of IFM. It's much, much smaller than IFM. Clearly at the moment it's only been going for a year, but that's one way of dealing with this issue, to make sure you get low fees, but also fee structures that are aligned with your interests.
And it goes beyond that. It's making sure that you understand your underlying investment.
Yeah.
So we didn't invest in CDOs before the GFC because we couldn't understand the underlying investment.
That's because it was not able to be understood.
Right.
It was not rational.
And we got out of subprime in 2006 because we looked at risk-reward paradigm. So
and you're saying you would have been more vulnerable to all that if you'd just been taking the advice.
Because if you trusted the rating agencies, all of this was AAA rated.
Yeah.
And a lot of it had the servicers on the outside AAA rating it on top of that. And without that own, or a smart consultant or the expertise in-house, you wouldn't have seen through that.
And that kind of links back to the governance point, doesn't it, about making sure that, you know, the standards of governance improve and standards of trusteeship improve so that, you know, you are able to take those decisions and actually go against some of the advice that you're given. And
Joanne, you were talking about investing in your own interests and your own members' interests. Broaden that out to the idea of impact investing. How much of an idea is that in the UK?
It's starting to become much more of a concept, and I thought the debate we had on that on Wednesday here was really fascinating. And we're seeing in particular a number of the local authority funds teaming up, partly to leverage some of the scale points that you were talking about, John. So the London Pension Fund Authority and Lancashire in the northwest have teamed up together to invest in their local communities. As I said, we have set up our own pensions infrastructure platform, and that is investing in predominantly UK infrastructure projects. So starting to become a debate. The sort of impact investing terminology isn't one that's got, say, perhaps quite the currency it has here yet, but it is something which we see as growing.
It's been huge for us, obviously, with the academic community, and I was
because they demand it.
Yeah, I was just with UniSuper, and we're comparing how many letters a month we get in about ESG impacting. Everybody has a different view. So,
darn these educated members.
and we've been at it for 20 some odd years. It started with the McBride principles in South Africa when we first started investing. So we have segregated accounts for SRI and ESG investing.
There's a question on the floor.
Oh, it's not on.
Have faith. Keep talking. No, it's not working. Can we get that microphone down there switched, fellas? Just say 1, 2, 1, 2 into it for a bit.
1, 2.
There you go.
Yeah, there we go.
It's gone.
No, I think it's that mic. Look, hang on, we've got another one coming to you. Thanks for that. Just swap that other one out. It's coming and going.
Thank you. Oh, a bit loud now. Actually, just on that point of impact investing and active, or your members obviously been very engaged in that, John, how are you dealing with organisations such as 350.org who are actively targeting, in some cases, university students and trying to put pressure on, it's happening here in Australia and New Zealand, trying to put pressure on people to make investment decisions?
Yeah, so particularly in response to that, we're actually coming out with a green choice fund for those that want that. So we have our social choice fund. We'll have a green choice fund as well. And then more broadly within the TIA general account, which is about 250 billion, there are like farmland principal guidance and LEED certified buildings and things like FSC timber certified. So it's across the whole portfolio, but what we don't do is say tobacco is bad across the whole portfolio or nuclear energy is bad across the whole portfolio. We have those segregated accounts for that. Okay,
just a couple of quick questions. We've got about 2.5 minutes left. Just briefly on the issue of life insurance. Does life insurance play a role in pension schemes or defined accumulation plans in the UK or the US, and should it?
Well, life insurers are very heavily involved as providers. If that's what the question is, life insurance itself will tend to be added on as sort of death in service benefits.
So in the past, so TICREF is a life insurance company itself, but our assets are 98% pension money. We've always felt that people should defer as much as they can for retirement and then do term life, but for people with more money now, we're saying use whole life as an estate planning tool. So it depends upon where you're at and all that goes with it, but it's part of a total financial picture.
Okay, and the final question, perhaps, unless there's anything else on the screen. Member engagement, the great unanswerable question. I'll give you a minute and a half for that one. TIAAF CREF survey found 3 times as many Americans would rather save for a holiday as save for retirement. 8% say they're focused on saving for retirement. 24% say Hawaii looks nice. What do you say on that? What's your best thinking on that, John?
I know somebody going to Hawaii, actually. She's in this room. So I think that's right for the young member, and that's why we're in a situation now where we have, trying to catch up with the Australians to a certain extent, auto-enrollment, auto-escalate, default options. Keep it simple. I think that's what it does for members, and then forces them. And then it's part of the education being at the worksite with community seminars, one-on-one counseling, web technology, the phone centers. It's pulling on them initially because they're not going to come to you.
Yeah.
Yeah, and I'd agree with that. And I think, you know, you could have run that survey in the UK and you would have probably got pretty much the same results. I'm not sure about Hawaii, though. Maybe the cost is all sold. But it's the same the world over. And so therefore, I think, you know, part of the key to this is smart defaults or smart pathways. And we've talked about those in the accumulation phase. And now it's much more talking about those in the decumulation phase, particularly when the response is, it's your money, you do what you want with it. Well, as a trustee, you want to make sure what people do with that money, that hard-earned money, is a good and sensible and safe decision. So it is about smart pathways, it is about smart defaults. And I think the debate on that in the decumulation area is just about to begin.
Yes, very well said, I would agree. Please thank the 2 members of our panel very much, John and Joanne.
Thank you.